My next guest is an expert at boiling down data and policy, right? Putting them together. I mean, it really is what determines what markets do these days, and no one does it better than Darius Dale. He's here in studio to share some of his secrets with you right after this. All right, so my next guest has gained a huge Wall Street following, really trying to seek answers to deciphering the economy, also with respect to policies, right, because they interact so well. 42 Macro founder and CEO Darius Dale is with us. And Darius, I want you to kind of walk us through, educate the audience, right? You've got these economic conditions, paradigm A, B, and C. First, let's talk about what they are and where we are now.
Yeah, absolutely. Again, thanks again for having me, Charles. So what we're trying to do is to help contextualize the full distribution of probable economic and policy outcomes for investors so that they can make the appropriate changes in their portfolio to remain on the right side of market risk. Paradigm A is where we're coming from. Sort of Biden's bloated, big government economy that really resulted in a K-shaped, sort of private sector. Paradigm B is where the market thought we were going.
Hold on, let's just stop here 1 second. So the K-shape, that was when one part of the economy was doing extraordinarily well, and the other part was not.
Both sectorally and from the perspective of households. Yet the upper income households were doing increasingly better, whereas low income households were doing increasingly worse.
Excessive government spending. We had the stimmies.
Absolutely.
The Fed over easy monetary policy. So it was just raining cash.
It was raining cash if you were rich. It was terrible if you were poor, and this is why we saw the electoral college map look like what it was.
Right. Okay, so paradigm B?
Absolutely. So paradigm B is the fear that the market had that we were transitioning to, which is an economy that will ultimately wind up being a better economy from the perspective of Main Street, but it would require a lot more pain from the perspective of Wall Street to get there in terms of, downsizing the government, the fiscal austerity, obviously putting up a tariff wall to reshore manufacturing. That's really difficult to do, and it would likely cause a downturn in the economy and markets that would be more protracted.
We know it's difficult to do, but it also, because the folks who benefit the most from this paradigm A, they control media, they control everything, and the messaging has been like people are afraid, they've been so afraid, even though this is ultimately designed to help them.
Well, this is why the media has been so focused on tariff. The reality is they understand that going from paradigm A to paradigm B is going to make them less rich and make Main Street more rich, and unfortunately, that's not what they wanted.
Paradigm C?
Paradigm C is ultimately where I think the markets are headed and the economy are headed, judging by the pivots that we've seen out of the administration. So essentially, paradigm C is a copy and paste of paradigm A plus incremental tax cuts plus incremental deregulation, both from a credit easing standpoint and in terms of increasing the supply in the economy. And you also have some reshoring of industries that are deemed critical for national defense. So it's essentially we're going to have take this K and make it a lot bigger. And so from the perspective of asset markets, that's structurally bullish for risk assets like stocks, credit, and crypto, and it's structurally bearish for defensive assets like Treasury bonds and the U.S. dollar.
So then, having said that, and by the way, you've been pointing this out, and what you pointed out, you told us is happening. It's been playing out to a degree in the markets.
Absolutely.
Bitcoin has, gone through the roof. Gold was already there.
Bitcoin's up 20% month to date.
Yeah. So my question, though, is there a point where we have to just settle in? Because there's also an anxiety, obviously, that's permeating in the air right now. Like yesterday when the bottom fell out of the market because of a sloppy 20-year bond auction. You never heard about that kind of stuff before?
No, not at all. And we got to get used to this as investors. Interest rates are going to go higher. We have a demand for populism amongst the U.S. voting base. We have a reindustrialization of different economies, including the United States of America. And we have a remilitarization of Europe. And plus the incremental militarization of both the U.S. and China. All those things represents demands for capital, where at the same time we're also supplying incremental capital as a function of legislation that's going to add trillions to the deficit. And so at the end of the day, there is a geopolitically driven supply-demand imbalance in the Treasury bond market that will cause some hiccups in the financial markets from time to time. But at the end of the day, what you want to be as an investor is exposed to the risk asset side of the equation and not the defensive asset side of the equation, because we're talking about an economy that's going to be on steroids.
Keep that in mind. Bottom line, keep paradigm C in your mind whenever you get a little nervous, because this will get you through it.
We're going to correct this summer. Just think paradigm C and buy the dip.
My man.
Charles, great.
Love the way you laid this out. Thank you very much.